What if I told you there is a brand new ETF on the market paying out a 14% yield every single month that has almost nothing to do with bonds, dividends, or the kind of option strategies you have seen on this channel before? It exists, it is real, and very few retail investors actually understand how it works. The fund is the Calamos Autocallable Income ETF, ticker CAIE. It launched on June 25, 2025, and in less than a year it has gathered more than $500 million in assets, making it the very first autocallable ETF available in the United States. JP Morgan acts as the swap counterparty behind the strategy. So what is an autocallable? It's a structured product that's been popular in private banking and wealth management for decades. The bank pays you a fat coupon, often double digits, in exchange for two things. First, you give up the upside of the underlying market. Second, if the market crashes through a downside barrier, the bank can hand you the loss instead of the coupon. CAIE packages over 50 of these autocallable contracts on indexes like the S&P 500 and the Russell 2000 into one ladder. The fund is designed to spin off consistent monthly income with a current annualized weighted average coupon of about 14%. Its very first distribution back in 2025 came in at an annualized 17%. The most recent monthly distribution worked out to around 13.5% annualized. Now here's what they don't tell you. The yield is not free. Each autocallable inside CAIE has a knock-in barrier. As long as the underlying index stays above that barrier, you collect the coupon. If the index falls hard enough to breach the barrier, your principal exposure starts behaving like a long position in a fallen market. Stack 50 of those positions in a steep sell-off, and the income story can flip into a loss story very quickly. There is also a ceiling. Autocallables cap your participation in big rallies. If the S&P 500 rips 25% in a year, CAIE does not. You agreed to trade that upside for the coupon. In a strong bull market, this fund will look boring next to a plain index fund. The expense ratio is 74 basis points. That is high for a passive index ETF, but reasonable for an actively managed structured note strategy you simply could not buy by yourself unless you were a private banking client. So who is this fund for? It's for income-focused investors who already understand options and structured products, who want monthly distributions in the high single digits to mid-teens, and who are comfortable trading equity upside and tail risk in exchange for that income. It is not a substitute for short-term treasuries or investment-grade bonds. One honest reality check. A 14% annualized yield is not a free coupon. It is compensation for taking real, asymmetric, market-linked risk. CAIE has not yet been tested through a serious bear market, and history with structured notes says the test eventually comes. If this breakdown helped you, hit like, subscribe, and tell me in the comments. Would you trade upside in a strong bull year for a 14% monthly coupon? I read every comment, and the best ones shape the next video.